Right, it looks like we have critical mass, so we will get started. And good afternoon, everybody. And although it's well into February, I'd like to wish everybody a happy new year. It's been a little while since we've had one of these calls, and we'll give you an update for the first quarter. I'm Jennifer Klein, Head of Wealth Management at Cambridge Trust. As we start this call, it's heartening to see the COVID numbers declining, and we're really hopeful that we'll be able to have more gatherings in person over the next couple of months. I would like to remind you that we are recording this call and it will be posted on our website in the next few days. Thanks to those of you who have submitted questions in advance. You can also submit them while we're talking in the Q&A section, which should be at the bottom of your screen, and we'll do our best to answer all of the questions that are asked. Today, I'm joined by three of my colleagues, Devin Brown, who is an attorney and relationship manager, Lindsay Donovan, senior investment analyst, and Brian Bickford, one of our senior portfolio managers. Devin will first discuss the importance of estate planning through the generations. Lindsay will then talk about our interest rate outlook, and Brian will close with our market and portfolio thoughts. We'll present for about 25 to 30 minutes, and then, as I said, we will take questions at the end. So again, feel free to post them as we're talking. So I will now turn it over to Devin, who will touch on a really important subject. Thank you. Go ahead, Devin.
Thank you, Jennifer, for the introduction, and I'm glad to be here with you all today. I hope you find the discussion and presentation helpful. So I want to start by just again saying our title here, The Importance of Estate Planning Through Generations, and it's really the conversation around estate planning that we want you to focus on with your family and loved ones. If you want to look at our estate planning statistics, you might be surprised by some of what you'll see. According to a 2021 poll, fewer than 46% of adults in the United States have a will. 30% of Americans do not know if their parents have a will. 40% do not know what is in their parents' wills. We know the next doesn't apply to any of you, but 64% of American adults who work with financial advisors have never discussed their estate plans with their advisor. And finally, the last bullet point is really what we want to focus on and a percentage that we would like to see reduced. And that is that 35% of American adults say they have either personally experienced family conflict or know someone who has experienced family conflict as a result of not having a estate plan or will in place. And that's what we want to reduce and speak about today. So the topic of estate planning can be intimidating, and sometimes the unknown is a problem in and of itself. So when starting these conversations, you want to start with the basics: who, what, and where. Who is going to receive your assets upon your passing? What are they going to receive? And where can we find the governing documents that dictate these distributions? Over half of adult children do not know where their parents store their estate planning documents, and 58% of those adult children don't know the contents of those documents. So I'm going to give you all a little bit of homework today, and I want you to ask your adult children or your beneficiaries whether they know what is in your estate plan, and to make sure that they know where to find them. If you are surprised by their answers, then it's a perfect time to start with these conversations. I did want to touch on digital considerations. That should really be a core part of estate planning organization, especially in 2022. I found it surprising that the average person under 70 has more than 160 digital accounts. And according to a poll, 63% of those who were executors of their parents' estates said it was harder than they expected to access the accounts of the deceased. So what we want to make sure is that when we're talking about estate planning, we also include digital information so you can pass that on to your children or beneficiaries. You can go to the next slide, please. So where to start? We want to focus on having the conversations before it's too late. And you'll see that I say almost too late because 90% of children who discussed estate planning with their parents discussed it after a life-altering incident. So we don't want to wait for an accident or an emergency to have these conversations. We want to really normalize estate planning. Our phrase that we want to use is discuss, create, and update so that your loved ones can advocate for your wishes. You want to leave a roadmap for your legacy. You might find it interesting to know that on average, Americans work 42 years before retirement. So you work really hard for a long time to build your estate and your assets. And we want to make sure that what you worked for is distributed the way that you intend. Next slide, please. You might be wondering what happens if you or a loved one passes away without an estate plan. So in the event that that happens, each state has what they call intestate succession laws. They are state specific, but since I'm sitting in New Hampshire, I just gave two really quick examples. So if you pass away with your children but no spouse, your children will inherit all of your assets. And then if you pass away with a spouse but no children or parents, your spouse inherits everything. So your assets will pass via probate, but probably not as quickly or as smoothly as if you had had an estate plan. So the next thing we want to focus on are the tools to your estate plan. So there's three major ones that we want to talk about. The first being wills, and most of us are familiar with the term and might have a will of our own. But to put it simply, a will is a legally enforceable document stating how you want your affairs handled and your assets distributed. Most wills will include a list of assets, possibly debts, physical items such as family heirlooms, and then a list of the beneficiaries that you want to receive these assets. It's important to note that if you do have minor age children, a will can also appoint guardianship of those children. Moving on to the next tool, trusts. So a trust, unlike a will, avoids probate. Property can pass to your beneficiaries almost immediately, and it is valid upon signing. So that means that while you're living, your assets can be organized and managed, also including any periods of disability where you can't communicate. Trusts are more flexible than wills, so you can account for what might happen in the case of a divorce of your adult children, and you can protect their assets against creditors. Finally, our last tool, and probably the least talked about, are advanced directives. And if you're not sure what an advanced directive is, you're in good company, because 1 in 5 American adults do not know what an advanced directive is. But the two major purposes for an advanced healthcare directive is to list out the types of healthcare treatments that you do and don't want, and to name someone to make those decisions on your behalf if you are unable to communicate. We want to make sure that you are in a position where if you are incapacitated or under some form of disability, that your intentions are carried out. So finally, in order to facilitate that, we recommend that everybody has an estate planning checklist. This one is very simple and it lists out the different tools that you might have as part of your estate plan. You can check off whether or not you have them. You can also list when they are last updated, the location so that your children or beneficiaries know where to find the documents. And then the last column is for a trusted contact so that you know who you spoke to about the documents and they know where to find them. That's the end of our talk on estate planning. And the point we really want to drive home is that it's never too late to start building your estate planning toolbox. I hope you found that helpful. Now I'll turn it to Lindsay Donovan, who is an investment analyst and trader, to lead our discussion on interest rate outlooks. Thank you.
Thank you, Devin. Good afternoon. Interest rate volatility has increased in the new year compared to 2021 with shorter maturities of the yield curve increasing in value by 15 to 20 basis points. Shorter maturities of the curve reflect monetary policy, and with language from the Federal Reserve minutes, as well as commentary from the governors around more restrictive monetary policy moving forward, the market moves in anticipation of the March meeting to see what kinds of action the Fed will begin to take to slow the impacts of high growth from last year that have extended into February. This high level of growth has translated to higher levels of inflation than the US has seen in the past 4 decades. The Fed has 2 levers it can use to adjust and impact rates. The first is to raise or lower the Fed funds rate, which sets the tone for the yield of shorter maturities. The Fed funds rate has been held at a range of 0 to 25 basis points, the historic low, since the beginning of the pandemic. While Chairman Jay Powell's remarks after the last Federal Reserve meeting cautioned that they were continuing to evaluate data and would make data-dependent decisions on any actions that they take, several Fed governors have communicated that they favor raising interest rates more quickly to fight raising inflation. There's talk that the Fed may not move in measured increments, as they have done in prior cycles, but could move in increments larger than their typical 25 basis points. The market has taken this commentary into consideration, and market predictions currently call for a rate hike of at least 25 basis points in the March meeting, with an increasing possibility of 50 basis point move. The market expects that the Federal Reserve will increase front-end rates by at least 100 basis points over the next 12 months. This is reflected in the current market, with 1-year treasuries yielding over 1% for the first time since early 2020. The second lever that the Fed can use to impact interest rates is through open market operations to increase or decrease the balance sheet. Since the beginning of the pandemic, the Fed has responded with unprecedented accommodative monetary policy, expanding the balance sheet's purchasing capacity to include mortgage-backed securities and corporate bonds. The balance sheet is now at its largest level ever seen, and the Fed will likely begin to reduce the size of the balance sheet later this year. There are a few unknowns, such as when they will begin the reduction and the speed at which the reduction would take place. A more aggressive runoff could lead to higher long-term rates more quickly. We expect to hear more details on this from the Fed in upcoming meetings. Since the beginning of the year, we've seen an increase in yield of more than 40 basis points in the 10-year Treasury, which today yields 2.05%. This has resulted in a compression of the increase in yield gained by investors from moving further into the future, with the 10-year Treasury yielding only roughly 50 basis points more than the 2-year Treasury. Many rate strategists forecast that the 10-year Treasury will close the year in a range of 2.25% to 2.5%. This is only 25 to 50 basis points higher than where the 10-year currently trades. Interest rates are impacted by inflation. With the 7.5% CPI read from January following another 7% CPI read in December, the economy is running hotter than the Federal Reserve's targeted inflation rate to reach a long-term average of 2%. The increase in inflation has been experienced by consumers in the increase in prices of everyday items like groceries, but is also taking a meaningful role in the higher prices of goods like used cars, furniture, and appliances. There's a dichotomy in the market, with higher inflation reflected in rates and prices today, but marketplace break-even yields that aren't currently reflecting inflation as a long-term issue. Short-term break-even rates remain high, with the 2-year above 3.6%. However, long-term break-even rates have lowered, with the 10-year around 2.5%, which is consistent with the Fed's inflation target. History teaches us that when the Federal Reserve begins to raise rates, the yield curve inverts. The slope of the yield curve is currently at the lowest position that it has ever been at the beginning of a monetary policy tightening cycle. Our concern, given this low slope, is what will happen to the shape of the yield curve when rates start to rise. Our strategies at Cambridge Trust focus on credit selection and sector positioning, with an emphasis on high quality, while maintaining a neutral duration within portfolios. Due to the uncertainty involved with predicting where and when interest rates move, we find that we can add more value to portfolios via our credit selection and tactical positioning to sectors to increase yields and impact total return. We believe that our internal research and individual credit selection is our greatest opportunity for total return in this environment. And now I'm going to hand it over to Brian to talk about the current market and our portfolio outlook.
Thanks, Lindsay. Yeah, it's certainly started off as a pretty challenging year so far, and certainly the Fed policy has been a big driver there, and we'll get to some of that as well in some of my comments. But I feel like the rise in risk and volatility is especially palpable because we're coming off a year where markets were so stable and rewarding last year. The S&P 500 last year returned over 28%, and it was just a steady rise higher. We only had about four pullbacks of 4 to 5%. Only one was 5% or more. And much of this steadiness, as was indicated by Lindsay, was driven by the Fed's zero interest rate policy and the quantitative easing program, whereby they were using the Fed balance sheet to essentially flush the market with cash and keep longer term interest rates low. In fact, the Fed grew its balance sheet from $4 trillion to almost 9 trillion since the beginning of the pandemic. So far in 22, we've seen a shift. We've already experienced a 9% pullback in the S&P 500. The technology-heavy NASDAQ has had a pullback of 14%, small caps similar, and the international benchmark, the All-Country World Index, which excludes the United States, was the one that hung in there, right, about a 5% pullback. Equity markets have improved a bit since the sell-offs. Year to date now, the S&P 500 is down about 6%, and after today's close, that's about in line. About 10% on the NASDAQ, 7.5% for the Russell 2000, and again, international being an area which has been more buoyant, down only 2%. But those index moves, don't tell the whole story. If we look under the hood and take a look at the 11 sectors within the S&P 500, you get a different story. And in fact, among those 11 sectors, there's a 35-point difference between the top performing sector and the bottom performing sector. So if we take a look at the top performer, energy, up 22% year to date. Clearly, higher energy prices and geopolitical risks in Russia and Ukraine have pushed energy prices higher and have increased revenues for energy companies. And then you have financials, also positive, up about 3% so far year to date. And again, higher interest rates can often be beneficial to financial companies where they make a margin on the difference between short and long-term rates. Then when we get down to the bottom, we're looking at about a 13% decline in real estate, very interest rate sensitive. The real estate investment trusts are often used for yield, and when rates are rising, that hurts them. And then it's sort of the winners from the last several years, those growth stocks that have done so well for us over the last several years, the information technology, consumer discretion, and communication services companies have had a challenge with this rising rate environment that Lindsay alluded to. And so there are many factors driving the shift, but the primary factor is the change in the Fed policy to combat inflation. And we've been experiencing during the most recent moves. The Fed is tapering their asset purchases and ending their zero interest rate policy with planned increases in the Fed funds rate. So they pushed their balance sheet up to almost 9 trillion. And at this point, they're dialing back the rate at which they're buying bonds. And the expectation is that by the March 16th meeting, that they will have stopped, using the balance sheet to buy additional bonds. And in fact, today we heard the minutes from the most recent Fed meeting, and later on in the year, they may actually start to sell some of the bonds that they've purchased. There seems to be consensus agreement that the first rate hike will occur on March 16th at the March 16th meeting. But as Lindsay indicated, there's debate as to whether they're going to start a measured pace of about 25 basis points per meeting, or if they're going to try to shock the market a little bit with a 50 basis point move. And right now it looks like there's pretty much a coin flip between the 25 and the 50. By summer, as indicated, we'll be looking at about 100 basis points. And consensus is that we're probably looking at maybe as many as 6 to 7 rate hikes by the December 14th meeting later on this year, where we may be looking at a Fed funds rate at 1.5 to 1.75%. And the 2-year Treasury's already started to price this in. We're looking at about a 153 yield on the 2-year Treasury. And that's up a full percentage point, actually a little more than that over the last 3 or 4 months. So clearly the market's anticipating the Federal Reserve increasing these interest rates. And as indicated, the next question is the balance sheet runoff. Are they going to allow the bonds that they've purchased to simply start to mature slowly over time, or are they going to engage in what's known as quantitative tightening, where they actively sell those bonds? So Fed policy change has been a big driver of volatility, but let's not forget other factors driving volatility. Front and center, the Russia-Ukraine standoff. We saw a rally yesterday on news that there may be some pulling back, although certainly not a sure thing. Let's not forget China, Taiwan, the Iran nuclear deal, and of course the midterm elections that will be coming up pretty soon. And as demonstrated by the dispersion in the returns in the S&P 500 sectors, the shift in risk factors are impacting the sectors differently. The geopolitical risks and supply-demand imbalances are impacting energy stocks positively, leading to their outperformance. Higher interest rates, may prove beneficial to financial stocks, but higher rates are also pressuring those growth stocks that have done so well, pressuring the valuations of those stocks as rates move higher. And ultimately, we're watching all these factors to get a sense for what the impact will be on the corporate earnings and valuation of the stocks and the markets in general. So far, S&P 500 earnings have remained healthy. 78% of the S&P 500 companies have reported their first quarter earnings. And the earnings surprises have been pretty strong. 77% reported positive earnings surprises. The average was about a 6% surprise, and year-over-year growth in earnings was 27%. Similar story with the revenue side. About 70% had beats and surprises on the revenue side, about a 3% surprise on average for 16% year-over-year growth. These results have trended a bit lower versus the most recent quarters, but still above average. And forward earnings revisions, so looking at what the expectation is for earnings looking forward, those have been continuing to edge higher, although at a slower rate. And earnings are expected to grow somewhere in the 8 to 10 range in 2022, and similarly in 2023. So corporations have done a nice job, delivering good results in a challenging inflationary environment with, high wage pressure and supply chain disruptions. And this has been evidenced by ongoing high profit margins. Most recently, the readings have come in at around a 12.4% profit margin, a bit below last quarter's 12.9, but well above the 5-year average, with projections modestly higher, for margins coming in the future quarters. On the valuation front, we're still looking at, above average price to earnings ratios. Due to the market decline and ongoing positive earnings revisions, the S&P 500 forward PE is currently around 19.8, maybe just shy of 20, down from the 22 to 23 range throughout most of 2021, but above the 5-year average of 18.6 and the 10-year average of 16.7. So moving in the right direction. We're paying a little bit less, in terms of a valuation for the market, but still a little bit above average. And we think that's somewhat justified given the fact that even though rates are moving higher, they're still historically low. And while equities don't provide the best results during these tightening cycles, history shows that they can still be productive, especially relative to cash and fixed income returns. We took a look at the last 7 tightening cycles going back to 1983. And in 6 of the 7 tightening cycles, stocks were higher 6 months after the first rate hike. So just because the Fed starts to remove their accommodation doesn't mean that they're going to completely get rid of any kind of rallying capability for stocks. In the one negative case over those 7 different tightening cycles, the stock market was down 1%. So on average, the last 7 tightening cycles, the stock market was up 8.1% 6 months after the first rate increase. Now, the current cycle is extremely unique. So, it's great to look back at history, get a sense for some confidence that, the markets continue to do okay in a tightening cycle. But again, we know that this cycle is extremely unique. And given the unprecedented monetary and fiscal stimulus, that has been deployed and the above average returns we've earned over the past few years, it's reasonable to expect returns to be on the lower end of the historical range. Equity investing during tightening cycles makes for tougher sledding. It's just a bumpier ride as the cushioning effect of Fed stimulus is slowly removed and full impact of the new information absorbed by markets. So, we've experienced that, where last year, a new news item would hit and the markets just kind of moved on and kept moving higher. And now it seems that every economic report, every report about Russia, every major earnings report is met by a significant move in the market. This is where complementing the equity portfolio with a high quality, moderate duration fixed income portfolio helps take the edge off. It provides ballast to the overall portfolio and serves as a source of liquidity if necessary. And generally, we do not want to have to be forced into a position to sell equities when they're down. And that's where having some bonds in the portfolio can be helpful. We're also emphasizing the importance of maintaining an appropriate cash allocation and would encourage clients to communicate with the relationship managers or portfolio managers if there are any known extraordinary cash needs in the foreseeable future. When we think about where the market is right now, and yeah, we're down 6%, but we're still 30+% above the levels we were prior to the pandemic. And we're 100% higher than the S&P 500 was at the low of the pandemic. So it's not like an opportunity doesn't still exist to raise cash if you think there's a need for capital looking out 6, 9, 12 months. We're still firm believers in the best way to generate above inflation real returns over time is through a well-diversified, high-quality equity portfolio, and we're maintaining full equity weightings. We're constantly working to improve the risk-return profile of our equity portfolios, and we've been diversifying portfolios by adding value exposure and currently considering adding to international stocks due to their lower valuations and higher exposure to defensive and cyclical sectors. So as I said, we're in an environment where it's just going to be a tougher challenge. When you're in a tightening cycle, the returns aren't quite as easy as if you were coming out of a recession and things were starting to really improve, but it can still be extremely productive. With that, I'll turn it back to you, Jennifer, and I guess at some point we'll open it up for questions.
Great, thank you, Brian and Lindsay and Devin. We do have some questions that have come through, and so let me just answer one of them quickly about whether the estate planning slides will be distributed. And yes, we'd be very happy to send those out to folks. And the checklist also will be sent out as a follow-up to this meeting or to this call. So yes, we're happy to share those. And of course, it's always an opportunity if you want to have a conversation with your relationship manager about those documents. We're available to help you in any way that would be helpful. There's another question, I think, for Brian, sort of paraphrasing. If somebody is at about 68% in stocks and 38% in bonds, is it time to move back towards a 60-40 asset allocation? So Brian, that one is for you.
Yeah, that's a question that really requires a more thorough conversation. I don't believe in sort of blanket answers to asset allocation strategy. A lot of it depends on a lot of factors. What's your particular situation, your needs for income, the size of your assets, et cetera. Whether your objectives are more, to provide assets for your lifetime, or if you're looking beyond your lifetime to children or people that might inherit your money or charities and those sort of things. So oftentimes, clients will look at a finite investment objective, based on their lifetime. But we find that oftentimes, there's more of a lengthy investment horizon because there's an inheritance nature to portfolios, et cetera. So it's a very specific, conversation that should be had, with the portfolio manager to talk about, again, also risk tolerance, how things are going. If people are, being impacted by the volatility. But I would say that in general, if people are thinking that, their portfolio is feeling a bit riskier than they're comfortable with, it's not too late to dial back exposure a little bit. As I mentioned, we're still at very high levels. We've had really productive years over the last 3 years. And you want to make sure that you have, a good 3 or 4% of your portfolio in cash. and that your near-term spending needs are covered. But again, it's a more complicated conversation than those few items, and I'd recommend reaching out to a portfolio manager and relationship manager to have a more thorough, specific conversation about your situation.
Great advice. Thank you very much, Brian. And, as we're thinking about estate planning, when I was doing a little Googling before this meeting, I remembered a couple of famous personalities who died without wills. Prince being one of them, where I think it's been 6 or 7 years now since he passed away, and they're finally settling his estate. So these kinds of things can really happen across the board, right, Devin?
Absolutely. I think it's a myth that, you might not have enough money or you might not be old enough to start these conversations, but we can tell just from media that it can really behoove us all to talk about it as soon as we're able.
Right, absolutely. And it's for you to decide how you would like things to happen after you pass away. Otherwise, somebody else will decide. And of course, you're no longer there to know, but it may not be the way you would have intended. Again, feel free to put any questions into the chat. We did have a question about what some of the longer term secular themes are that we think will affect the markets going forward. So Brian, do you want to take that one?
Sure, I'd be happy to. And yes, we're big fans of thematic investing, trying to identify longer term secular trends, that we can, jump on board and experience the rewards of some of these really popular trends that generate good profits for corporations. And I'd say some of the ones that come to mind, certainly transportation, electrification, electric vehicles is one that we're adding exposure to, not necessarily in some of the individual auto manufacturers where we find that valuations have become troublesome, but more so on the infrastructure side, the ability to harden some of the electrical infrastructure, for charging and things of that nature. There's a couple other themes that we think are ongoing that we've been enjoying for quite some time now, mostly on the technology side, cloud computing, AI, semiconductors, maybe most recently the metaverse or Internet 3.0. There are several tech companies within our portfolios that are exposed to these. And even though these are some of the companies that have run up, over the last several years and have given some back recently, we still think that trend has a long way to go. And these tech companies that we own, generating all kinds of cash flow, highly profitable, low leverage sort of investments. So much different than the sort of, late 90s, 2000 tech companies that really struggled. Within the healthcare, genetic medicine, gene therapy, we have several, companies that are exposed to some of those trends. And we think there's going to be some good opportunities within those, but those are just a few that come to mind, Jennifer.
Thanks, Brian. And then there's a question of what do we mean by the term secular? And you want to go ahead and explain that too?
Yeah, when we refer to secular, we're talking about a trend that reaches across cycles. So when we think about a cycle, we're usually talking about something that is just within one business cycle. When we talked about the Fed tightening right now, that's a cyclical concept that, the market's gotten hot here. We've got an inflationary situation. We've got to address it. A secular term would be something, like, I guess I would use the cloud computing or electric vehicles. That's something that is going to, be a multi-cycle phenomena. So something that has a duration that exceeds a single cycle, generally 2-3 cycles, sort of 10 plus years as opposed to the usual 2, 3, 4 year cycle.
Great, thanks, Brian. Question for Devin, is there a need for a financial power of attorney in estate planning documents?
So I would say yes, but kind of the method or format of that is going to vary by state. So in New Hampshire, that form is covered by the general advance directive that you would fill out if you were going online, or probably if you're meeting with your estate planning attorney. That's encompassed with the healthcare directive. Some states it's a separate document. So when you are thinking about the advance directive, you do want to think about the financial power of attorney component. Absolutely.
Great, that's a great question. I swear I didn't plant this one, Brian, but there is a question about concerns about inflation, and is an allocation to commodities appropriate, or thinking about private equity or other alternatives?
Yeah, we certainly have been using and benefiting from some exposure to commodities. You take a look at commodities across the spectrum between fuels, as well as industrial metals, as well as even in the terms of Ukraine, they're talking about agricultural commodities and some of the inflation that might result of that. So yes, across portfolios, we are utilizing commodities exposure through some funds. Inflation has been a big concern, and the expectation is that we're going to start to see some improvement in inflation as we get toward mid-year, and that's why investors are watching these CPI and PPI numbers so closely. We certainly got a spook in the market last week when we got that 7.5% inflation number. And so, the Fed will get one more inflation number before that March 16th meeting. And we think that's going to be a pivotal piece of information that will probably drive, if there is going to be a potential for 50 basis points, it might come on the heels of another high inflation number. But yes, I would say that, commodities, private equity, is a sort of a completely separate category. It's difficult to get private equity exposure in a marketable instrument. Most of the investments that we're utilizing come in the form of, mutual funds or individual equities. Private equity, generally is a more unique asset class that we currently aren't utilizing.
Great, thank you. Why don't I just give it one more moment to see if there are other questions from the audience? I always call this the Zoom pause. It's always a little longer than is comfortable, but typing sometimes takes a second or two. Okay, well, seeing that there are no questions, I'd like to thank our panelists, Devin, Lindsay, Brian. Thank you so much for your comments. I think they were extremely helpful. Thank you to all of you who participated in this and listened. I would like to tell you we have an upcoming virtual event on cybersecurity on March 10th, and there will be an invitation sent out fairly soon on that. We've got a great speaker lined up. He can talk a little bit about things that we all can do in our home environments to try and protect ourselves in a time when there's plenty of phishing and other intrusions into our networks going on. So that should be a really interesting session. So thank you again. It's a pleasure to present to you, and we'll look forward to speaking with you soon. Bye-bye, everyone.